In this video, we are going to talk about a trading strategy for perpetual futures. So those are derivatives, those are levered bets on crypto prices. Now, when we trade those perpetual futures, we have to pay a funding fee or we receive a funding fee, depending on what's currently the most popular trade. Now, those funding fees are paid out periodically. It depends on what platform we trade. In this video, we are going to discuss Hyperliquid that pays out the funding fee every single hour. So this is more of an advanced topic, but I still think it's interesting, even for the people that are not trading perpetual futures regularly. So for example, have a look at this. There is Hyperliquid, and if we were to bet on a rising near price, we'd now have to pay 10.95% annualized, or for the next tick, 0.0013%. That's the funding rate that gets credited to the shorts and is paid by the longs. Now that funding rate fluctuates. Sometimes it goes up, sometimes it goes down, depending on the demand for the perpetual futures. Now I want to backtest a strategy here. We want to simulate a strategy to take advantage of that funding rate. So let's say the funding rate is extremely high or extremely low. And with that cutoff, that hourly cutoff, we would get paid a lot of money. Does it potentially make sense to buy that asset, then collect the funding rate, and then subsequently sell the asset again? If the round trip cost of buying and selling the asset is lower compared to the funding rate, maybe it makes sense to do that trade. In other words, we take advantage of a second order mispricing. A mispricing of the price relative to the funding rate in the derivatives market. So as I said, this is a bit more of a complex topic, but if you've been able to follow so far, this might be interesting for you. Now, extreme funding rates are rather rare. We've got a logarithmic scale over here, and getting more than 1% for an hour of holding the asset happened only in 43 observations. 1.5% is only in 8 observations, so 8 hours of the entire sample size. Above the 15 basis point threshold, so that's what I said for the round trip costs, we've got 10 basis points, so 0.1%. For the transaction fees, another 5 basis points for the bid-ask spread or for slippage. That happened 2,617 times. The vast majority happens with negative funding rate, not positive funding rate. In other words, this is when many people want to bet on a falling price. This happens much more frequently than people suddenly rushing into an asset and pushing up the funding rate. Now have a look at this. 99.8% of all data points that we have fall outside of our threshold. Again, notice this is a logarithmic scale. So this is a very, very spiked distribution chart. The hourly funding rate is on the x-axis. The count of the hourly observations is on the y-axis, again, on a logarithmic scale. So as said, extreme funding rates are very rare and they're always negative. People betting on a falling price, not on a rising price. Just have a look at the ratio, right? The rising price events happen extremely rarely. Just check those numbers versus the falling price events. So fundamentally, what that means is that whenever we do that trade, we have to buy the asset and then collect the funding rate that the shorts are paying to the longs. This is a strategy, even though it's not intended to be, that's one directional. It tends to just be long, not so much short. Now, this is just the first part of a two-part video because I made this analysis, unfortunately, not having all the data available. Ideally, what I wanted to do is to buy the asset just 1 minute before the funding rate payout, collect the funding rate, and then sell 1 minute afterwards. But in order to backtest this, we need to have a lot of 1 minute data points. The problem is that the Hyperliquid API cuts this off after 3 days. So the 1 minute intervals, we only have the last 3 days of. For the 1 hour intervals, we've got much, much more. And so the problem is we can't really simulate buying just before and buying right after. The only thing that we can simulate so far for this video is to buy directly at the cutoff. So we buy the asset once we know the funding rate will be very high. We hold it for the entire hour, and once the funding rate got paid, then we sell. So I know this is not the ideal simulation, right? We have now price exposure for an entire hour. And ideally, we want to just collect the funding rate within that short time period. Still, in theory, maybe those price fluctuations over this 1 hour just cancel each other out. And it's still worth it. So I still went ahead with the analysis, but there will be a follow-up roughly 1 month from now. And if you don't want to miss that follow-up, then feel free to subscribe over here, potentially even hit the notifications. Now, check this out. So here we've got the number of potential trades. So hours where we had more than a 15 basis points payout on that funding rate. Only 3 events for the 1 minute data, 43 events for the 5 minute data, etc. Again, this is a logarithmic scale. The only real backtestable strategy right now with our data set is to buy 1 hour before the payout. I just set 200 as a bar, 200 trades to make this a somewhat statistically significant backtest. And so here's the result. If we buy just at the announcement of the high funding rate, so fundamentally this is how it works. The funding gets paid out, then the next period starts, right? The next hour, and with the next period, we know now the funding rate of the next hour. So once we know that funding rate of that next hour, we enter the position and then we hold it for 60 minutes, get the funding rate and then sell. That's this bar over here. On average, that lost 30 basis points or 0.3% per trade. We've got a sample size of 1,592 trades. Now we do have some sample size for a tighter period. 30 minutes, 153. And we can already see when we've got a shorter holding period that then the numbers improve. If we don't sell directly after the cutoff, but we buy 1 hour before and 1 hour afterwards, then the loss per trade is the highest. So my big hope here is once we've got the follow-up analysis and then we actually just hold 1 minute before payment, 1 minute after payment, that this might turn green, that over here we might get a positive return after cost. So fundamentally what this means is the longer we hold the asset, the worse the performance gets. In other words, when people bet on a falling price of an asset, when the funding rate is negative, that's also when the price tends to go down. So the perpetual futures traders in masses tend to be right. When everybody bets on a falling price, that's also when the price tends to go down. So when we want to collect the funding fee, then we want to hold the asset as briefly as possible. And if you hold for an entire hour, this is not profitable, unfortunately. So we have collected 28 basis points per trade, but we have lost due to price movements 44 basis points. So 100 basis points is 1%. We have our 15 basis points in costs. So that's 10 for the round trip cost and 5 for slippage, netting us, and we add all of those 3 together, minus 30 basis points. So that's this bar over here. And if we hold for another hour, then of course we lose even more towards price movements. This is a strategy that needs to get automated. Here's the outcome distribution. We've got very big tails. The mean return is minus 30 basis points. The median return is even lower than that. In other words, the positive tail is a bit larger than the negative tail. But as I said, this is structurally a long only strategy. Even though we could also go short when the funding rate is extremely positive, it does not happen that often. Usually the market, it's most aggressive when it wants to bet on falling prices. And so what does this data so far tell us? It tells us that the perpetual futures market is quite efficient. If the funding rate is very high, then the price tends to go up. If the funding rate is very low, the price tends to go down. Perpetual futures traders on average know what they're doing. Now this might not necessarily be the retail traders, this might be market makers, but on average when the funding rate is currently very negative, the price tends to decline. Now this is a good signal also for the average retail trader that does not trade the perpetual futures, because if you just want to short-term hold your asset, if you buy your asset on the spot market, it probably makes sense to buy the asset when the funding rate is not extremely negative. As in, when the vast majority of people are currently betting on a falling price, that's when the price tends to continue to fall. And the effect is pretty strong, right? If the funding rate is very negative and you just hold for another 2 hours, on average, you're losing 7.4% basis points. Now there's also some transaction fees here, but it's still 0.6%. You are losing 0.6% if you're ignoring a highly negative funding rate. You don't want to buy a falling knife. rather the opposite. Now we could also flip this around, right? Because if this is consistently negative, we could also just short with all the others, right? When the funding rate is very, very negative, maybe instead of trying to collect the funding rate, we are okay to pay the funding rate and we just take advantage of the continuation of the falling price. This could actually work. Forget about this top chart over here. This is a look ahead analysis. It doesn't really work. We don't know the funding rate ahead of time. But have a look at what we've got here at the bottom. That's when we trade directly at cutoff, when the funding rate is announced. If we trade to collect the funding rate, we have a pretty consistent underperformer. That's now cumulatively 50,000 negative basis points. But imagine we were to flip this around and now we bet on a falling price whenever the funding rate is extremely negative. That would suddenly be interesting. So what started out as a simulation to scalp the funding rates on the perpetual futures now turns into a potential trading signal that maybe if funding rates are very negative, we want to just go with the flow. I haven't yet run that analysis, but I'm planning to do this very soon. And that will be published even earlier. Now there's also a PDF report with everything that has been discussed in this video, all the different charts with different explainers. That's in the link down below. So feel free to check out the pinned comment. That will bring you to a website where you can either connect your Telegram or input your email address, and then you will get this for free sent to you. As usual, thanks for watching. If you found this interesting, feel free to give this video a like. It will help the channel grow. See you next time. Cheers.